que le voy a pedir al equipo de producción que por favor lo tenga allí. Ese señor es Bianco, quien es el presidente de Macro Strategies en su propia firma. Obviamente es una persona que la conocen muchísimo en varios medios de comunicación. Es como una especie de enciclopedia ambulante porque Jim comprende perfectamente todo lo que está pasando. Obviamente le está escuchando allí Mi Pasión en español. Ya vamos a hablar con él y creo que la primera pregunta que le vamos a hacer es ¿qué piensa él justamente de los aranceles y de las tarifas? Porque cuando lo vemos en otros medios de comunicación, él tiene su explicación de lo que puede estar pasando. Jim, it's a real pleasure to have you here at Negocios TV. You hear the passion and everything we're doing at the extension of the closing of Wall Street. And we would like to not only want to thank you for being here, but right away ask you, what do you think about the tariff? You hear what's going on today in the market. We keep going up slowly but surely. We want to listen to you and listen your explanation about it. Thank you.
Yeah, thank you for having me. The tariff story is one of the United States let's talk big picture for a second. The United States got itself into a position where it's been borrowing too much money. It's been relying too much on foreign investors to recycle those dollars because of its large trade deficit back in the United States. And I'm speaking primarily of China right now. And there was a belief that something had to be done about that. And that was what we saw with the plans that we've seen out of the Trump administration highlighted by the tariffs. Now, the way they've done it, maybe they could have done it better, but it has created a lot of animosity and it's created a lot of volatility in the markets. But lately being the last 2 or 3 weeks, we've seen them start to reverse their policies a little bit. Backing off on the reciprocal tariffs, backing off on some of the other tariffs. And then the day that we're recording today, Commerce Secretary Howard Lutnick is announcing that he has a deal done, waiting for the approval of the country's parliament. It's believed to be India, and that might be the first trade deal that we've got, with hopefully more to follow, that will provide markets with some clarity as to what could potentially be the end game with all these tariffs.
And listen, and based on that, and I hear some of the other opinions that you made across different media outlets. And remember, our audience are from the typical person that is learning about the markets towards portfolio manager, analysts, and so other professional traders in the Latin American, Spain corridors, all of us that speak Espanol. But actually, I want to hear your opinion about what might happen if all of these rumors do not materialize in more than memorandums of understanding, and you don't see real juice and action, because obviously we're seeing the hard data starting to roll, and I have some news that we might be on a recession, and also I'm betting that the Fed might cut rates next week in anticipation of what might happen, because obviously if you go to Trueflation or other websites that have alternative data, the inflation seems not to be the problem. But I want your opinion, because obviously you're an expert seeing all the charts and dynamics data, quantitative analysis. What do you think about that? What do you think is going to happen if they don't come with any real new about Japan, about Europe, about India, and also all the other countries in the world?
Well, you're right that we're in an unusual situation in the markets right now. The economy, as of the moment we are talking about, and I'm speaking primarily of the U.S. economy, is in okay shape. The fear is in 90 days, if we don't get any kind of deal or none of these memorandums come apart and we reinstitute the tariffs after the 90-day pause, that the economy will be in much worse shape. This is unusual. I want to emphasize one thing. We've never seen this before. The economy's fine, but in 90 days, it's going to be terrible. If anything, it's always the opposite. It's the economy's terrible, but in 90 days, it's going to be fine, is what people think. So we're anticipating something that may or may not happen, and we'll have to see. Now, the one thing I would say about Trump is he's a transactional kind of guy. He's not very ideological. He's not out to hurt the U.S. economy if he doesn't get any deals, or if things go really bad. I suspect he will change his policies like he has, and would probably continue, that they wouldn't be so bad. But to your point, The other question is what does it mean if we get no deals? And there's a big difference between Wall Street and Main Street in the United States. When you ask people on Wall Street, what happens if we get no deals? They say loss of jobs, slower economy, recession, the Fed needs to cut rates. If you ask Main Street, what does it mean if we have no deals? They think higher prices, hurry up and buy a new iPhone, hurry up and buy a new car before the tariffs come into place. And so they're worried about inflation. So where does the Fed come down on this? I've been arguing that the Fed and their statements by Jay Powell, the Federal Reserve Chairman, have been closer to, we're worried about inflation. And if you tell me there's going to be no deals, we're going to be worried that that means inflation, and that means we're not going to cut rates. We don't want to stimulate the economy into higher prices because that could foster even more inflation. This is the big question on Wall Street is what does the Fed do if we have no deals? I think they do nothing because they're more worried about inflation than they are about a slowdown.
I see, because obviously there is a different bucket of economists and analysts that are seeing exactly what you mentioned about the fact that there is not enough data, there is not enough willingness from the FOMC to actually go and cut in anticipation of, and you're absolutely right, if there is no deal, you're going to have a big shock that basically all of these major alternative data outlets are telling us with regards of the trade from China, the shipments, and so on. But in the other end, there is some certain papers out there that mention that the president, with what is commonly known as the Trump pot, he wants to do whatever it takes to see the 10 years lower. And now today, Jim, as we are speaking, which is 3:11 Eastern Time on April 29, which is 9/11 actually in Madrid, you are seeing the 10-year coming from the 440s, 430s to 417, which is basically telling you that some people are buying. And a few days ago, and I want your opinion, the guys that are managing Pinko, they are saying that there is incredible opportunities at these levels, even though that we might have a deficit, that we don't know what's going to happen with potential new tax cuts, that they see that the bonds might be going below 4. So at the end of the day, it's a big confusion. And I want perhaps to ask you something that I hear that is pretty interesting. You mentioned the 456. So I never heard something like that, but I think it makes a lot of sense. So I want to hear your expectation for the inflations in the next few years, so you can explain the audience the 4, 5, and 6, which probably make a lot of sense down the road, please.
Yeah, so on the first part about why interest rates are coming down is that there is hope that there's going to be deals. Those deals are going to prevent prices from going up, and that is going to hold back the tariff-driven part of inflation. That's why the stock market's going up too, and interest rates are coming down, or people are buying bonds again, because they're hoping that we're going to see some kind of a deal there. 4, 5, 6. I've argued that over the next several years, cash in the United States, a money market fund or treasury bill will return you 4%. Bonds, longer-term maturities and fixed income will return you around 5% or so. That's what the average coupon is in the United States. So you get the coupon, plus or minus some kind of capital appreciation. And stocks, because of their high valuations, historically, when they're very highly valued, they don't do very well. They return just a little bit more than bonds, is 6. So that you're looking at markets that are going to return you 4 for cash, 5 for bonds, 6 for stocks. And I think part of what's driving that is if you were to step back from tariffs, we have had in the United States since the end of COVID for 5 years, elevated inflation. Now the Fed is saying, well, we got the inflation problem fixed and we're on our way down. We're still in the high 2s to low 3s, depending on high 2% to low 3% inflation rate, depending on which measure you use. The Fed wants the inflation rate to be under 2%. It hasn't been close to that number since COVID, and it's actually started before tariffs kicked in. It started to stall around the high 2% range. That is a big difference, to be between 3% inflation and 2% inflation, because that drives interest rates. You might say, what's the difference between 2 and 3% inflation at the store? Maybe it's not a lot for some people, but if you're worried about interest rates, if you want to know why cash won't go much below 4, is if we're stuck in around a 3% inflation world and you put a little premium on that, then interest rates, at least in the front end of the curve, the Fed funds rate shouldn't get much below 4%, and then 5% for bonds and 6% for stock returns.
Listen, Jim, to finish here, I want a little explanation on a more, let's say, actionable ideas. And the S&P right now is in the 5,500 plus, the 5,566 points as of now is the cash. And obviously, we know that we are in a trading range, at least for the last few days. I think the high was at the end of February, and I don't think that we're going to go again and pursue the high unless something extraordinary might happen, which I don't know what it will be. But what you will do at this level for the regular people that have some sort of anxiety where their 401ks and something that they feel that is problematic in the economy, what do you think is the best, safer places to go, considering that we just don't know, but we need to keep investing and rolling opportunities as they appear? What do you think?
So, you're right. The S&P is down about 4% or 5% for the year. It was down about 14% for the year about 3 weeks ago. So it's made a bit of a comeback, but it's still down on the year. And I'll go back to my 4, 5, or 6. If you're worried about the stock market, and look, it's given us 2 great years, it was up 22% in 23 and 25% in 2024. I think you need to temper your expectations to something like 6%. Now, bonds can return you something, most of what the stock market's going to give you, around 5% with less volatility. Cash can give you about half to 2/3 of that expectation with no volatility. Treasury bills don't have very much volatility. Money market funds don't have very much volatility. But I think it's really about expectations. If you're looking for what's going to give me that big, 20 or 30% gain, I don't think it's going to be the stock market anymore. It's going to be more in terms of themes or stock picking or something like that. Right now, the big plays that are working are gold. European stocks are working, but they may not work for all time. And so we have to adjust for the type of environment we're in. We're not in that kind of environment anymore where stocks just go, because their valuations are so high right now. They need everything to go right to produce big returns. And in an era of tariffs and change, that doesn't mean we're going to get everything go right. Now, it doesn't say it's going to be bad and it's going to be a disaster. It's just going to be tough sledding from here forward.
A curiosity to finish, what do you think about the Bitcoin? It's been kind of holding and a little bit decoupled from the NASDAQ, at least a few weeks ago. But what do you think about the Bitcoin? Do you think that we're going to go over 100 and 150,000? Do you see those levels? Do you have clients asking you about specifically that asset class for the next incoming quarters?
They're constantly asking me about that asset class. They never stop. But yeah, you're right. We're about 95,000 on Bitcoin. I am encouraged that it is breaking its correlation from the NASDAQ. I had always been disappointed that Bitcoin just acted like a high leverage version of the US NASDAQ. It doesn't, if that's all it's going to be, it's never going to fulfill its promise. It should act independent of it. And it's finally starting to act a little bit independent of it. As far as whether or not we're going to get to 100, 150,000, say in the next year or two, I still think that there's still more issues that need to be resolved around cryptocurrencies, especially around the development of decentralized finance and stable coins and potentially competition with the central bank digital currency. That's going to hold it back. That's not going to wipe it out, but it's going to hold it back. But over the long term, many years, it has a very promising future to be the alternative financial system, the disruption that I would argue the world really needs. Because maybe in Spain and in the United States, we don't need Bitcoin. We have developed financial markets. We have safe banks. But the rest of the world doesn't. And the rest of the world could use something like decentralized finance and a global currency like Bitcoin. And that could be its promise. And then if it does fulfill that promise, then those big high prices that everybody's looking for can be realized. I'm optimistic it'll do it. I just don't think it's going to be in the next year or two.
Listen, we have a blast having you in the TV show. very happy. We're going to invite you again. You're going to promise that you're going to come from time to time, because at the end of the day, you are a reference, one of the analysts out there that have your own ideas, and I definitely enjoyed a lot. And thank you, Jim, for coming. Looking forward to speaking with you again. Thank you very much.
Thank you.